Well, hello there. Amy Lewis from the KFBK Morning News with Brandon Haefele from Catalyst Mortgage. Of course, it's time for the Catalyst Report. This is really important, too, because you may not realize this now going into the second month of 2018. Today is the time that we're going to talk about Home Equity Line of Credit, HELOC, H-E-L-O-C, Home Equity Line of Credit. And what you may not know is that home equity lines of credit are no longer tax deductible. So they were.
Yeah, exactly, Amy. People used to be able to pull out a home equity line of credit, essentially a second mortgage, like a credit line secured by your house, and put whatever on there from auto to home improvements, and then whatever interest that you would pay, deducted like you would mortgage interest. And as of January 1, 2018, it's no longer a deductible item.
So what does that do to me if I'm, if I need some cash?
Well, first up, it depends. I'd say if you have a home equity line of credit, you really want to make, look at your situation, talk to your tax advisor, also talk to, your loan officer that you've worked with in the past, and find out, does it make more sense for you to consolidate that via a cash out refinance of your first mortgage and consolidate the two loans into one? And it's important to know that in some cases, it might not make sense. I mean, if you have this line of credit for $150,000 limit, but there's a zero balance, it doesn't make sense to, of course, do anything. It's there for an emergency. But over the last few years, people have put auto, home improvements, college education for their kids on a line of credit.
Yeah.
So it really would make sense to consolidate that into one loan.
Would you put a college education on a home equity line of credit?
Personally, what I know, I would not.
No.
But I would say that the idea of
it
somehow
depends
leveraging
on the situation too.
Exactly, somehow leveraging either your home equity plus the interest standpoint, it does make sense in certain circumstances. The reason I say I wouldn't is because of the variable interest rates.
Right.
Especially right now as we see interest rates rising, the economy's doing much better. We have wage growth and so on. With those factors, we have rates going up. The first thing that's going to be affected is a line of credit because it's an adjustable rate mortgage.
Can you get a home equity line of credit and not do anything with it for a while?
Absolutely.
And if you can, then how long?
Absolutely.
How long can it just sit there?
This is a great thing. I really recommend, if you have the equity in your home, have a home equity line of credit there for a rainy day, for an emergency. Home equity lines of credit will be cheaper. The rate will usually be cheaper to have on the home versus having a credit card where you might do a cash advance. Or if you have to go get a personal loan, an unsecured personal loan at 10, 12, 14%. You might be in the 4 to 6% range on a home equity line of credit. But for that rainy day, for that emergency, it's a great avenue. To answer your question on time, home equity lines of credit could be open for 10 years. And you might just have a yearly fee that you pay for like a renewal or an annual fee to have it open. But realistically, it's something that could just be there for that rainy day.
So when you think about having an equity line of credit for your home, do you have to keep in mind that the interest rates are going up? Like you said, they are.
If you're holding a balance, absolutely.
Yeah.
You really want to be cognizant if you have anything on that. And I would really urge
there's got to be a
consumers-
science to this. Seriously, I mean, that's why you're in business.
Right.
Duh.
I would really urge consumers right now, if you have an equity line, take a look at the statement. Right after the Federal Reserve raises interest rates,
Right.
whenever they do, within, I would say, a matter of days, if not the next day, you'll either get an online notification or you'll get something in the mail a couple days thereafter saying your new interest rate on your home equity line is X. They will adjust it based off of what the Federal Reserve does. And that is something that is an immediate impact. In past segments, we've talked about how the Federal Reserve doesn't affect mortgage rates directly. We don't see the Fed raise rates and all of a sudden mortgage rates jump. There's not a connection there. It's the economy who's investing in mortgages and so on. But when it comes to equity lines, there is a direct connection from when the Fed raises rates to that increase. So I would tell consumers, really look at your statement, look at what the interest is, look at if it makes sense, either potentially paying it off if you have the cash in the bank to do so, or doing that consolidation. Example of last week, we had a consumer that we were looking at a loan. They had about $175,000 in an equity line, various things from education, they did home improvements. I mean, really, we're talking a bunch of stuff. Most people might have pulled cash out, from their home to do this. Well, they had a 3.625 30-year fixed, and then they had this equity line at $175,000. Well, this is now no longer tax deductible. That interest is no longer a tax deduction. On top of that, this variable rate was about like a 5.3, I think it was. Point is, they said, well, we don't want to give up this low, rate in the threes.
Yeah.
By consolidating those two together, the actual adjusted rate plus the tax loss, and tax benefits that they were losing, their tax advisor was like, even if you get a 4.375 on a refinance, it's still worth it to consolidate those two so that all of the interest is a write-off.
But did they know that they could do this, or did they learn that through you or from their tax
they'd
advisor?
come to us, and we also advised, hey, this is what you're approximately looking at on rate.
Yeah.
But you also want to talk to your tax advisor and see what they're saying. Really for your situation, again, it's not a one size fits all
Never
in our industry.
Yeah.
But so many companies will try to tell you it is, and it's not. It's really important to educate yourself on your own scenario, and then also get the tax advisor to look into it, have the mortgage advisor look into it and see. Because in this case, a low rate in threes didn't mean anything, because ultimately they were paying their adjusted rate, loss of tax benefit was totally, it was astronomical, the effect that it would have on them. So consolidating into one fixed rate, even though it's in the low fours now, was still totally worth it.
So don't be afraid of getting a home equity line of credit, a HELOC, but go in with the knowledge that you need to know how to make it work best for you.
Exactly. It's not tax deductible now. And one thing to keep in mind, put this out, is you can always refinance right now, pay off whatever your equity line balance is, and still keep the home equity line open. You can subordinate the actual line, pull cash out of the first just to pay off whatever that balance is. Let's say it's $35,000 or $40,000. Pay that off, have it within the first mortgage, and still have that line of credit for an emergency, for a rainy day.
All right. Well, that's a lot to ponder over, right? A lot to chew on. But that's what you get with the Catalyst Report. If you have any questions, you can call Brandon or his amazing team at Catalyst Mortgage, 287-7777. But really, you've just got somebody in your corner, somebody to stand by your side through this whole process. Someone like Brandon and the whole team at Catalyst Mortgage. Check them out on our Facebook page, too.